Well, that was US President Barack Obama commenting on the jobs data which was out on Friday. You're back with us on Capital Connection, and we're taking a check on the Forex markets. Now, we're watching to see the reaction in the Forex markets to that jobs report, which actually came out during the session, remember, in the States on Friday. We are watching sterling at 164.72. The Aussie dollar is managing to strengthen a bit today against the US dollar at 91.63. Taking a check on the euro, which clearly has been strengthening quite strongly over the past 9 months or so against the dollar, standing at 148.94. And just taking a check as well on dollar yen, which obviously has been impacted too by the jobs report. 89.87 is where we currently stand. Now let's bring in Mario Singh, co-founder and CEO of FX1 Academy, who joins us live from our Asian headquarters and is with us now for a bit more on this story. First of all, let's find out what you made of those figures from Friday, the jobs figures, which were much better than had been expected. But how much can you read into one set of data like this?
Well, the market was expecting job cuts of about, say, 125,000 to 130,000. So the figures that came out on the non-farm payroll of job cuts of 11,000 literally blew away the expectations of the whole market, really. So that's when we saw the dollar rally from Friday, in fact, even continuing till today. Now, when that's the case, I'm seeing some continuation of the rally in this whole week. So that sets the tone for this week. What I do want to put in as a point of reference, even at this economic climate right now, the dollar strengthens in two reasons. Number one, when you see bad news all over the world. And number two, when you see good data coming out of the US. So over the last 2 weeks, we actually saw these two scenarios playing out with the Dubai debt default the week before and last Friday of the NFP. How much could we actually read into that? I don't know. We're going to see the revision next month, but really what's happening now, traders this whole week are taking up the whole figures and they're trying to crunch in the numbers because it really blew away all expectations.
The trend over the past year, though, has been whenever you get good data from the United States, the dollar goes down as risk appetite goes up. Why didn't we see that this time around? Are we moving away from that?
Well, the current climate now, as we see, is a lot of very sentimental movement in the whole dollar this whole year. So what's happening now is when we see risk aversion, people are flying to the dollar for the perceived safe haven status. So that is still continuing, I would say, throughout the first half of 2010.
Okay, you have some advice to give to the U.S. on if they want to strengthen their currency. That's assuming they want a stronger currency. Some would say they don't.
Okay, great. I would say at this point of time, they probably will not want to strengthen the currency because you've got to take up the trade deficit, the budget deficit. We just saw the budget deficit as a soaring $1.4 trillion of the fiscal year 2009. So do they want to keep it low at this point? Yes, the answer will be yes. But moving forward, I want to share some points on what I call the tiger effect. Now, let's assume that after the whole first half year plays out, the U.S. does want to strengthen the U.S. dollar, which I do presume they would want to do that because Bernanke's been saying it, Geithner's been saying they've really got to show the market now how forceful they want to be. So I'm borrowing a story from what we have seen last week in the sports world, the Tiger Woods effect, how he has rattled the whole sports world of what he has been doing. So I'm going to call it the Tiger effect right here. There's 5 points that the U.S. can do if assuming they do want to strengthen the dollar and send shockwaves throughout the financial markets. Number one, T, the acronym, let's use the word Tiger here. Number one, T stands for treasuries. The U.S. has got to stop buying treasuries right now, which they are doing in a certain point of time. So that's great, right? That's number one. Number two...
selling treasuries. Selling U.S. treasuries.
Yes, that's right. That's right. And number two stands for income. So income stands in two ways. Yeah, income for the government, income for the people. All right. Now, what does that mean? Let me talk a little bit more about that. Income for the government. They probably has got to start thinking about having taxes, about value-added taxes. Right now, they really want to send shockwaves through the whole financial markets. They've got to start thinking about taxing, or rather what I call the VAT tax. So U.S. is currently the only economy right now in the 30 countries of OECD that hasn't really implemented the VAT tax.
Politically unpopular, though. It's going to be difficult to do heading into elections. And the issue on stopping, if I had that much debt, isn't it easier for them to simply inflate their way out of it as opposed to letting the dollar strengthen?
Absolutely. That's a great point. This is something that traders are now weighing A as opposed to B right now.